Hi everyone, thank you for watching my channel. This is Perry Trade, and if you're new here, please remember to like and subscribe. So in this video, I want to go over a presentation on introduction to futures. And the reason why I created this presentation is because so many people have asked me, what is future trading and why do I trade future? Like, what are the advantages of future trading? So this video is I designed it for not just for beginners but also those who've never traded before. You don't need any financial knowledge or don't need any prior experience in trading. So this kind of gives you an overview of what is future trading. I'm not going to go like deep dive into the into future trading. So I would suggest you that after this video to go back, and if you're interested in future trading, go back, read books, read a lot of books, watch a lot of YouTube videos, a lot of webinars to understand more about futures, because there's way more in future trading than this video would provide you. Okay, so this is just an overview. So let me just go into the next slide. So let's begin with the big question. What is future trading? So think of it like locking in prices, right? So that way, if prices go up, you've already locked in prices, you know. So let's just give you an example. Let's say there's a concert going on, right? And so the concert is not going to happen until like 3 months from now, right? So you want to buy prices. No, you want to buy the ticket prices today, right? You want to lock in the prices today, because later on, supply and demand, once those ticket prices, once you get closer to that, to the date of the concert, those ticket prices are going to go up. So you want to lock in prices today. That's with a lot of things, right? Even college prepaid, you're locking in prices today because it's definitely going to go up by the time your kids are ready to go to college. Those prices are going to go up, so you want to lock in prices today. So that's basically what futures contract are. You have a contract, it's basically a contract, and you're locking in prices. So the contract exists for all sorts of things. It's also for like commodities like oil, gold, wheat, coffee, and also financial instruments like stock indices, interest rate, and currencies. And the cool part is that these contracts are standardized and they're traded on the official exchanges like the Chicago Mercantile Exchange, the CME. This means they follow specific rules and can be traded by anyone with access. So why do people trade them? There's two main reasons: to manage risk and to speculate. To manage risk just means basically you're locking in prices today because prices are going to go up in the future. So you're just locking prices today. It's a contract you make with the buyer, okay, and that's what managed risk. To speculate, just basically you're just betting on prices. You're just basically betting on prices are going to go up, or you're basically betting that prices go down. And also we're talking about more about these two groups, so hedgers and speculators, in just a bit. So just remember, future trading is making a deal today for a price tomorrow. So why do people trade them? There's two main reasons: to manage risk and to speculate. So to manage risk, you're locking in prices today, and to speculate just means that you're betting on where price is heading. And we're talking about more about these two groups, hedgers and speculators. And just for now, just remember that future trading just means that you're locking in today's prices for tomorrow. Now that we know what future trading is, let's take a quick look of where it came from. How did it originate? So future trading didn't start on Wall Street. It actually started on the fields with farmers. A wheat farmer is planting crop in the spring, but harvest isn't until the fall, right? So farmers worry, what if wheat prices crash by then? They could lose money. So to protect themselves, farmers made deals with the buyers, made deals to lock in prices today. So they agree on a price today even though the wheat won't be ready for months. So this way, the farmers, number one, the farmers know that they'll get a fair price, and number two, the buyers know how much they'll pay. So both sides reduce uncertainty, and this is called hedging. All right, remember when I talked about managed risk? These are the hedgers. All right. So if we fast forward today, and while farmers still use futures, now we also have, you know, hedging for all sorts of things, right? Hedging for airline fuel prices, tech company hedging on currency risk, and traders and institution making bets on the market for profit. And that's what we do. When I trade futures, I'm basically hedging. So future trading involve from a simple tool, right, for farmers to the global market that serves hedgers, speculators, and investors alike. It's all about reducing risk and taking advantage of the opportunity, just like wheat farmers, but on a much bigger scale. So, what makes futures different, and why we trade futures as opposed to like other instruments? So, what makes trading futures different? Why would I trade futures? So now that you've got a basic understanding of what future is and where it came from, why would someone choose trade futures instead of just buying stocks and trading options? So, and also, what is the real advantage? So let me just break it down. There's four main reasons, right? There's leverage, there's speculation, number three, there's hedging, and number four, 24-hour trading. So number one, leverage. You're basically doing more with less. So one of the biggest reasons people are drawn to future trading, like myself, is that you can leverage. Leverage is basically having the ability to control large position with a much smaller amount of money, right? So for example, let's say a future contract is worth 100,000. In the futures world, you might only need to put down 5,000 to $10,000 in margin to trade it. And I'll talk about margin a little bit later in the slides, right? That's like making $100,000 bet, but only needing like 5 to 10% up front. That sounds powerful, right? It is, but it's a double-edged sword, right? Why it matters. Well, if the market moves in your favor, right? So if you're betting and prices go up, and it does go up, then you make big gains, right? Quickly. But if it moves against you, then your losses can rack up just as fast, right? So leverage can amplify your wins and your risks. That's why risk management, which I'm going to talk about in the last slide, is everything in this game. So number two is speculation. Speculation is basically what we do when we trade futures. We're betting on price moves, whether it goes up or go down. Futures are a favorite among active trade because they're built for speculating on price, whether you think it's going up or down. Unlike buying stocks where you only profit if prices go up, future makes it just as easy to go short, to profit when prices fall. And I say that because even when prices go up and down, you still make money. Just like what happened when we heard the tariffs news just last week, the market just tanked, right? So if you were on top of your news and stuff, and you know that okay, the president was about to announce the tariffs news, then you already were shorting the market. I say short. Well, we have terms in trading called long, go long, and going short. Going long is that you're betting on prices go up, and then going short, you're betting on prices go down. So if you had a limit order to go short, then you would have made a lot of money when the market had went down just last week. And the market is still going down. Let me just give you another example. We're going to just talk about fuel prices, right? So let's say oil is trading $90 per barrel, right? And you believe it's going to drop, right? So you can sell futures contract now as if oil, and if oil falls to $85, right? Because remember, the oil trading was trading at $90, and you believe it's going to drop, right? So if it falls to $85, you buy it back cheaper, and then you pocket the difference. So you can do this in both directions, which means that you're not stuck waiting for a bull market. A bull market, that means when all the buyers are buying, and then the price go up. And then bear market is when the traders are selling, and then the market goes down. So you can trade during rallies when market's just going up. You can trade during crashes when market go down, and you can trade everything in between. So futures give you the flexibility to act on your analysis no matter which direction the market goes. So number 3 is hedging. Hedging is basically reduce risk in business or investing. You know, we've talked about this before, but it's worth highlighting again. Futures weren't invented for day trading, right? They were built for risk management. Like we said in the beginning of the slide, you're just basically locking in prices so that when prices go up, you're already locked in. They're still used for that today. So for example, airline worried about rising fuel costs, right? And so they lock in today's oil prices with futures. Even if oil spike in the next few months, their cost is protected. Another example, like we talked about before, you know, the farmers, of course, they lock in prices today before the harvest so that they don't have to fear that price is going to drop. And so this is called hedging. It's like having a financial insurance. It doesn't eliminate risk entirely, but it gives you a plan and reduces surprises. Investors, producers, importers, exporters, they all use futures to stabilize costs and protect their bottom line. And lastly, 24 hours, 7 days a week trading. Trade on your time. Unlike stock market, which typically runs from 9:30 a.m. to 4 p.m., futures market are open almost around the clock, right? Especially during weekdays. This means that you can respond to, you know, overnight news or events, breaking headlines without waiting for the market to open. So, for example, we knew that the president was going to announce the tariffs news, right? Was going to announce it on, I think it was like Wednesday, right? Wednesday at 4 p.m. Was it Wednesday at 4 p.m. or Thursday? And so what happened? If you knew that if you knew because of the tariffs news, you knew the market was going to crash, So you already put in a sell limit order to go ahead and sell. And so when the market went down, you made a whole lot of money, right? So this is a huge advantage. So why trade futures? Well, because when you combine leverage, right, more bang for your buck, speculation, profit potential in both directions, hedging is just built-in risk management, and then extending trading hours, flexibility in case news come out, right? You get a powerful dynamic and full of opportunities, right? So that's what you get. But the key with that opportunity comes responsibility. Futures aren't for gambling. Okay, futures aren't for gambling because when I go into a trade, I don't go into a trade and hope that price is going to go up, go down. I have indicators, price action that tells me what direction price may go. All right, so you never hope that price go in either direction. They reward discipline, planning, and patience. And that's why they're used by serious traders, hedge fund, institutional investors, and business around the world. So let's zoom out for a second and let's look at the big picture. Because one of the most common questions people ask is, why trade futures? Why not stick to stocks, crypto, forex, right? That's a good question, and it's one worth answering, right? So each market has its own personality. It has their pros and cons. And so let me just kind of explain the advantage of trading futures as opposed to this other, instruments, right? So one of the biggest difference is leverage, and leverage and how long you can trade. Future trading gives you high leverage, meaning that you can control a large position with relatively small amount of money. Let me give you an example. You might only need $5,000 to trade a $100,000 future contract. That kind of leverage is also common in crypto, forex, but not in stocks unless you have a margin count, and even then it's more limited. Also, future market are open almost 24 hours a day, right? 5 days a week. So this is huge. It means that you can react to global news, overnight market events as they happen, not just during regular U.S. stock market hours from 9:30 to 4 p.m. So if you like the idea of more flexibility and after hour action, futures gives you that edge, similar to crypto and forex, right? So number 2, regulation, safety and oversight. So let's talk about regulation, okay? And when I talk about regulation, I mean how much protection you have as a trader. Futures market in the US are highly regulated. They're overseen by agencies like the CFTC, the Commodities Future Trading Commission, and trades happen on well-established centralized exchanges like the CME and Group. And you'll notice when you watch a lot of futures videos, or like my future video, I would show a disclaimer letting you know the risk involved in future trading, and that's just so you can let the viewers know the risk involved, right? So compare that to crypto, which, let's be real, it's still like it's still not regulated, it's deregulated, right? Some platforms are unregulated. Sometimes you'll have scam and hacks that can happen, and legal protection can be weak and non-existent, right, in crypto, right? So if having a safer, more structured environment matters to you, future trading offers more peace of mind than crypto does, right? And often more than forex as well. So number 3, pricing and transparency. You got centralized versus decentralized. So how pricing works? Future price comes from a centralized exchange. Everyone sees the same price. No confusion, no variation. In forex, on the other hand, price is decentralized. It depends on the broker. Since you're trading over the counter OTC market, that means price can differ slightly between platforms. So in crypto, prices vary between exchanges too, but which can lead to inconsistent or slippage. So if we prefer clear, consistent pricing where there's no guessing game, future might feel a lot more solid, right? Might be more solid. So number 4, ownership versus speculation. So let's talk about what you're actually trading. When you buy stocks, you're buying a piece of company, right? You're a partial owner. You might even get voting rights or dividends, right? When you buy futures, you're not owning anything. You're trading a contract that reflects what you believe price of something will be in the future, whether that's oil, gold, or the S&P 500 or the Dow Jones. It's purely about price movement, not ownership. This is more similar to crypto or forex, where the focus is only on price speculation, not equity. So future trading sits between all of these worlds. It has the flexibility of forex and crypto. Number 3, the regulation of stocks, the speed and leverage of true traders market. But that also means it requires discipline, education, and strong risk management. Unlike stocks where you're just trading companies, or forex, or where you're just dealing with currency pairs, futures trading lets you tap into all kinds of market. From the price of crude oil to performance of the entire stock market, future contract gives you access to a wide range of global asset that makes this market incredibly versatile, right? So let's break it down by category. So you can just see how wide the playing field really is, right? So you have stock index futures. These are some of the most popular future contracts in the world. So instead of trading one company stock like Apple or Tesla, you're actually trading the performance of an entire index, right? So let me explain. So you'll see S&P 500. The S&P 500 is basically the 500 of the biggest U.S. company. You have the NASDAQ. The NASDAQ, which I trade now, is tech heavy. giants like Apple, Amazon, Nvidia. So those are just all the tech companies, right? I know you've heard about the Dow Jones. Dow Jones is basically the 30 major blue chip US companies, and the Russell 2000. Russell 2000 is the 2000 small cap fast growing US companies. So that's what all those index are, right? So for example, if you think of the stock market is going to go up, right, after a strong job report, you can go long. When I say long, meaning you're betting on the market go higher, you can go long on the S&P 500 futures, right? So if you think it'll drop because of weak earnings, then you can go short. No need to pick individual winners or losers. When I say you don't have to pick any individual stock, so you're either choosing the S&P or the Nasdaq, right, which is like a group, like just like how I explained, a group of companies, right? So just getting an average of all those companies. No need to pick individual winners. You're just trading the whole market. Commodity futures, this is where it all started. Real physical good, right? Tangible items, right? We're talking about wheat, corn, soybean, coffee, sugar, gold and silver, copper, crude oil, and gasoline. Let me just give an example. Let's say you're a coffee producer in Colombia, right? And you're worried that prices might drop by the time the coffees are ready, right, to harvest, right? You can lock in today's prices using futures contract. That way you're protected even if price goes down. So on the flip side, if a trader might buy coffee futures, right, expecting price to rise and hoping to profit from the move, right? So futures in this category help both producers manage risk and investors speculate on big price swings driven by supply and demand, whether weather or global events, right? Currency futures, the FX futures. Currency futures work kind of like trading forex, but with standardized contract on regulated exchanges, right? You'll see contract on major currency pairs like US dollars, euro, Japanese yen, or the British pound. For example, imagine a US company that does a lot of business, right, in Europe. If the euro weakens, they could lose money when converting the sales back to dollars, right? So to protect themselves, they use zero futures to lock in exchange rates now, and that's hedging. That's hedging against currency risk. And then meanwhile, a trader might buy euro futures if they believe euro is about to strengthen, right, based on news from the European Central Bank. So number 4 is interest rate futures. Yes, you can even trade futures direction of an interest rate. These contracts are based on things like U.S. Treasury bonds or notes, short-term interest rate like federal funds rate. And let me give you an example. If you think interest rate is going to fall due to the recession, right? You might buy Treasury futures because bond prices usually go up when rates go down, right? But these contracts are super important for banks, institutions, and large investors who manage billions of dollars and want to protect against rate fluctuation. So while this category is more advanced, it's critical. It's a critical part of the financial system and is useful once you're deeper in the game, right? And number 5, you have energy futures. This could technically fall under commodity, but it's big enough to deserve its own category, right? So these contracts cover natural gas, crude oil, and gasoline and heating oil. Let me just give you an example. Let's say tension rise in the Middle East, right? And there's threat to the oil supplies, right? So traders might jump into crude oil futures expecting price to spike. But at the same time, airline might use oil futures to hedge fuel costs, so they're not caught off guard by price jumps, right? Energy futures are incredibly liquid and often very volatile, making them popular among short-term traders. So let's talk about the big takeaways from this, right? So future contracts don't lock you into one market. They're open door to everything: agriculture, stock, currency, bond, energy, like we just described. All right. Before we can really get into how futures work in the stock market, we need to talk about something foundational, right? Stock indices. Because when someone says they're trading the S&P 500 or the Nasdaq future, they're not buying shares of Apple or Google directly. They're trading the entire index of those companies that they're a part of, right? So, what is a stock index? It's basically a basket of stocks grouped together to represent a portion of the market. Think of it like a report card for a specific part of the economy or the economy as a whole. And in the world of future trading, these indices are some of the most active and liquid contract around. So let me just break it down to four major indices you'll hear about, right? And maybe even trade, right? So number one is S&P, the market's MVP, I guess we call it, right? This is the big one. The S&P tracks 500 largest publicly traded companies in the US. We're talking about heavy hitters like Apple, Microsoft, Amazon, Google, and Johnson Johnson. So when people say the market is up, the Wall Street's having a good day, they're usually referring to the S&P, right? Because usually we do follow the S&P. If the S&P 500 is up, then usually all the other indexes are going up as well. It's a market cap weighted, meaning that large companies influence the index more. It gives you a snapshot of the overall US economy, especially the large cap sectors, right? And in future trading, the ES contract, the E-mini S&P 500 is one of the most traded instruments in the world. You also heard about the Dow Jones, right? The Dow Jones tracks the 30 large U.S. companies like the Boeing, the Coca-Cola, Goldman Sachs. These are big, established firms across multiple industries. It's one of the oldest indices and still get a ton of attention from news outlet and financial media, right? But here's a key detail. It's price weighted, not based on company size. That means a stock price at 400 will affect the index more than a price at $50. Even if $50 stock is much bigger company, right? So while it's useful and familiar, it's a bit more old school in how it operates, right? You also heard about the Russell 200, right? So the Russell 200 tracks the 2,000 small cap US company. They're a smaller, often fast growing firm that don't make the headlines like Amazon does. The index is seen as a barometer for Main Street, the smaller business that makes up the backbone of the US economy. So if you want to trade volatility or bet on performance of growth sectors, this index can also offer you big moves, right? In the futures market, this is traded through the RTY. So um, all these index have symbols, right? RTY. Also, the Nasdaq. So the Nasdaq is what I trade. Okay, so the Nasdaq is NQ, and then if you trade the micro is MNQ. Okay, so the Nasdaq 100 includes the top 100 non-financial companies listed in the Nasdaq exchange. It's heavily weighted towards technology and innovation. Like names like Tesla, Meta, Nvidia, Apple, Netflix, right? So if you believe in tech or want to trade its up and down, then this is your index. It's tend to be more volatile and momentum driven than others, right? Futures on this index are traded via the NQ contract, right? Like I explained before. And let's talk about the real world application, reading the indices, right? Look at the live market snapshot like CNBC. So I go to CNBC a lot and I look to see what direction the market's going on the screen. So if you go to cnbc.com, you'll see the ticker and you'll see the how whether the market's going up or down, right? Whether it's green or red. So each one shows the price movement up and down in points, percent change, and volume sediments. Future trading are constantly watching these numbers to anticipate the market direction and place trade accordingly. So to recap, why indices matter in futures, right? So when you hear S&P 500 future are rising pre-market or the Nasdaq future plunge after tech earning, what that really means is traders are speculating on where these entire basket of stocks are heading, right? Not just in one stock, but the whole section of the market. Let's zoom in and understand the mechanics behind the actual futures contract. So I'm going to walk you through each part step by step so it all makes sense. So even if you never looked at trading screen before. So first, let's look at this table, right? This table shows some of the most active trading futures contract, right? Especially the US stock market, right? So let's just break it down. The point value, what each point is worth, right? Think of it like dollar per level of movement, right? Example, the ES, the S&P 500 moves from 4,200 to 4,201. That's 1 point. And 1 point in the ES is worth $50. So a 10-point move is equal to $500 profit. Each futures contract has its own point value. So always check this before trading. So the minimum tick is the smallest price movement. This is the tiniest step that price can move. So for ES, the minimum tick is 0.25. That's 1/4 of a point. And since 1 point equals $50, that means 0.25 is worth $12.50 per tick. So if price jumps 2 ticks, that's 0.50 points, right? That's a $25 move. This helps you calculate profit and loss in real time, especially if you're scalping or day trading, right? So the required margin is what you need to place a trade. Margin is not a fee, it's a deposit. It's the amount of money your broker requires you to have in your account to open and maintain a position. And when I say position, when you go into a position, open position, that means you're in a open trade, right? And when you close a position, that means you close out your trade. And so that margin is now placed back into your account. For example, to trade one ES contract, you might need $3,000, right, in margin. This number changes based on volatility. It does because your broker can also send you updates on depending on the market volatility. That margin may change, may go down, may go up. Think of it as like renting a car. You put down a deposit, right? So the dealer knows, well, the car rental company knows that you can cover any damage or losses. So that's basically what it is. So what else do you need to know? So tick versus point. Again, a tick is the smallest price movement of a contract, and a point is made up of several ticks. Knowing the tick size and value helps you track how much you're gaining or losing, even on small moves. So quick example, if you're long on the NQ and price moves up by 4 tick and each tick is worth $5, that's a $20 gain. So margin, this is your safety net. Your broker use your margin deposit to make sure that you can cover potential losses. So if your trade goes against you and your account balance dropped too low, you can face a margin call. That they call it, where the broker requires you to deposit more funds or automatically close your position. So it's always good to monitor your margin, especially in volatile market. Also, too, you have expiration dates. Unlike stocks, which you can hold indefinitely, futures contract expire. So usually monthly or quarterly. So when that happens, your contract is when your contract is about to expire, you have two options. You close out your trade before expiration, or you roll it over to the next month, right? Contract basically exiting the old one and entering a new one. For most traders, especially short-term one, expiration isn't a big deal because they don't hold it for too long, especially day traders, or they go in the market, come out. They don't usually hold it overnight or for long periods like position traders do. So let's look at the big picture. So what are you really managing, right? When trading futures, you're kind of juggling three things: price movement, margin, and time. Price movement, what I mean by price movement is how many ticks or points has the market moved. Margin, do you have enough capital to open and hold your position? And time, when does your contract expire? At first, all of these numbers might seem intimidating, but once you practice reading them, they become second nature, right? So let's give you a bonus tip. So if you're starting out with futures, trading futures, there's two futures. There's the e-minis and also there's the micro contract. So micro contract was created for people who don't have enough capital, right? And so when you talk about micro, right? So let's say I trade the Nasdaq, right, which is the NQ symbol. So the micro is the symbol for micro is MNQ, right? So for those people that have enough capital, these were created so that people can trade, right? So the micro contract are 1/10 of the regular contract, right? So trading micro, like let's say the MES, right? The S&P, right? These have smaller tick value and require lower margin. Now, let's talk about something that may seem boring at first, but it's actually critical to your success as a trader, right? So choosing the right broker. Because let's be honest, your broker is more than just a website or an app. It's the foundation of your entire trading experience. So the right broker can make your trading smoother, faster, or more profitable. The wrong one can make it frustrating, poor execution, you might have limited tools and maybe even lose money. So whether you're just getting started or just planning to level up, let's just break it down and how to find the best fit for you, right? So for beginners, these are my suggestion. Okay, so do your own research. I always say start simple and start strong. So if you're new to trading, your top priority should be the ease of use, right? It has to have educational resources, responsive customer service support, and have practice environment. Those are the demo accounts, right? So my suggestions are just TD American Trade, Thinkorswim. People have heard of that. E-Trade, Tasty Trade, used to be Tasty Works, okay? TD American Trade is like probably the most trusted names in the industry. They have advanced charting, technical tools, right? Tons of free educational content, right? E-Trade is clean, intuitive, right? Strong mobile app, web platform, good for beginners who want to trade futures, right? And Tasty Trade is designed for retail trader, right? They have low commission. They're more focused on active traders, but still easy enough for motivated beginners, right? And their content team produces tons of trading educational videos as well, right? So for more advanced traders, right, speed, control, and customization. Once you got some experience under your belt, you probably want more control, right? You want speed, you want customization. And so these are the platform these are my suggested platform. I use NinjaTrader, all right? NinjaTrader is great, and NinjaTrader would be something that I would highly recommend to a lot of people because I use it, I understand it, it's intuitive, has a lot of educational resources. So it's known for its ultra detailed charting, advanced order type. It supports automated trading strategies. So if you watch my channel, I do a lot of automated trading, create bots where it takes a trade for me. I use NinjaTrader for that. It's the most widely used platform among professional traders and offers both free, there's a free version, and paid plan depending on your trading style, right? They have the AMP futures. They have low commission, right? They integrate multiple charting platform like Sierra charts or multi charts. So another key factor to keep in mind is when comparing brokers. These are the things that you need to look for, right? Fees and costs, commission per trade, data fees. Okay, so data fees like when you get your data from, right? Because some of the data that you have, even the free version, you might have maybe a 10 minute delay, and so you don't want to have that. If you're trading live market, you want to have subscribe for data fees, platform fees, and also margin rates. Margin rates, it's also a big thing, so you want to make sure your margin aren't too high, that you want to have available margin to take trades. So because fees adds up, especially for active traders, so always check the fine print. Also, too, you want to keep in mind is the tools and feature. How good is the charting? Do they offer indicators? Most trading platform offers indicators. Strategy back testing, that's important. And also algo trading. Those are the bots. Also, too, can you place complex orders like OCO and bracket orders? Those are also important too. So again, I'm not going to go in detail in that. That's something that, I'm doing it out there for you, and then you can go and research and understand more. So the more tools you have, the more confident you'll be in your trades, right? Market access. Can you trade micro futures, right? Do they offer commodity currency futures, right? Not just indices. Can you access international markets, right? Paper trading, simulators, right? This is the big one for beginners. Practicing on a demo account lets you test your strategy with zero risk. Look for brokers that offer real-time and delay simulation environments, right? And so one final thought, right? There's no universal best broker. Only what's best for you, right? One size doesn't fit all. Ask yourself these questions, right? Do I want to keep things simple or get deep into data? Am I trading casually or building towards full time? Or do I need hands holding and tutorial or raw speed and advanced tool? So again, try out the demo accounts, read reviews, traders forums. Don't be afraid to switch if something doesn't feel right, because I've tried different platform, and I've stuck with NinjaTrader because that's what best fit my trading style and with all the feature that it provided. The broker you choose is like a trading partner, so make sure it matches your goal and your experience level and your long-term vision. All right, now let's talk about one of the most important tools in future trading, right? Candlestick chart. And I know when you look at trading platform, you always see candlesticks, right? If price action is the story the market is telling, candlesticks are the language it is written in. And once you can read them fluently, you'll be able to, number one, spot momentum, identify reversal, time your entries and exit more confidently, and avoid trading blindly. I'm just going to break it down step by step. So what exactly is a candlestick, right? So each candlestick represents a price movement over a certain period of time. So when you see one candlestick, right? Let's say you're on a 1 minute chart. Each candlestick represent 1 minute. If you're on a 5 minute, each candlestick represent 5 minutes. So after 5 minutes, a new candle form. Same thing for 1 hour or 1 day, depending on how you set up your chart. Now, every candlestick has two main parts. You have the body. This is the thicker part of the candle. It shows where price has opened. So if you're looking at a green candle, price is open on the bottom of the candle, right? And it closes on the top during that time frame. So the wick, or sometimes people call it shadow, these are the thin line extending above or below the body. They show the highest and the lowest price reached during that period. Think of it like this. Imagine watching a tug of war, right, between the buyers and sellers, right? The candlestick tells you who pulled harder and how far the rope moved before the clock ran out. So let's talk about the colors, right? So you see green. Green always means that the price is going up, and red. These are the universal colors, right? In trading, right? But you can customize how you want it when you start trading. So green versus red. That's basically tell you what side the market is going, right, during that period. Let's say green, the closing price was higher than the opening price, meaning buyers were stronger. This is called a bullish candle. The red, the closing price was lower than the opening, meaning the sellers had control. This is a bearish candle. So just by glancing at the chart, you can see which direction the market is moving, who has momentum, and where the push and pull is happening. So I'm going to talk about some common candlestick pattern. Okay, there's hundreds of candlestick patterns out there, but don't worry, I'm only going to kind of go over some of the few ones, right, to get started. And let's go over like 4 beginner friendly pattern, right? You'll see over and over. So the doji is the indecision candle. It looks like a cross or a plus sign. The open and close price are nearly the same, right? This means that neither buyer or sellers won. It's a tie. It often show up before a reversal or a big breakout. You also have a hammer. The hammer, buyer stepped in. Small body on top, long width underneath, like a hammer. Appears after a downward move and shows buyers are pushing back. And this can signal a bullish reversal, especially if confirmed by volume, right? You also have the shooting star. Sellers hit back. The opposite of a hammer, remember. Okay? The shooting star is the opposite of a hammer. Small body on the bottom, long upper wick. Appears on the top of an uptrend and it signals weakening buyer strength. May point to a bearish reversal coming, right? So engulfing pattern. A power shift. 2 candle, one small one followed by a large one that completely swallows it, right? A bullish engulfing pattern means the buyers are overpowering sellers. A bearish engulfing candle means the sellers are taking control. These are often seen as turning points in the market. So why this all matters, right? The psychology behind the candle. Candle shows more than price. They reveal the emotion and psychology of the market. Remember that. Who is winning the tug of war? Buyers or sellers? Is the move strong or weak? Are people hesitating, charging in, or backing off? Learning to read the candle is like learning to hear the crowd at a sports game. You start to feel the momentum, the fear, the greed, the hesitation in the market. How to use candlestick effectively. Candlestick pattern are the most powerful when used together with support and resistance, with volume, with indicators like the RSI, the MACD, stochastic, whatever you choose to use. Example, if you see a hammer candle forming right on a key support level and volume spike, that might be a great long setup. Now, let me give my final thought, right? Every candle tells a story. At first, candle chart might look just like a bunch of green and red blocks, right? But once you learn how to read them, right, they're telling a story. So I suggest that this is kind of just an overview, but you go in and you understand and read and look at YouTube videos to understand more about reading price action and candlesticks. So price action basically is learning the different patterns and knowing what these candlesticks are telling you about the market. So it's like learning a new language, one that helps you understand the heartbeat of the market, right? Okay, now we're getting into the most important concept in trading, especially in futures, right? Long versus short position. Remember earlier I told you long is buyers are buying in the market and price is going up, and short is you're betting on the market to go down because sellers are selling, right? This is something that sets future trading apart from just buying and holding stocks, because in future trading you're not limited just hoping prices go up, like I explained before. Not hoping, okay? You can make money when prices rise and you can make money when prices fall. So let's walk you through what that actually means, starting with a more familiar one, right? Going long. Buy low, sell high. This is the classic trading idea most people already know. You expect price of something to go up, so you buy first, then sell later at a higher price. Example, let's say oil is currently trading at $70 per barrel. You think it's going to rise because of supply shortage. So you buy future contract at $70. A few days later, oil goes up to $80. You close a trade and the $10 difference is your profit. This is called going long. and it means you're betting on prices increasing. So real life analogy, it's like buying a concert ticket early for $70, then reselling it closer to the show for $80. You pocket the difference, just like in a long trade, right? Going short, sell high, buy low. Now here's where things get interesting, right? And different from traditional investing. You expect price of something to go down, right? So you sell first and then buy it back later at a lower price. Yes, in the futures market, you can sell before you even own the asset. This is called short selling or going short. Let me give you an example. Let's say gold is trading at 1,900 per ounce. You think it's about to drop. You sell futures contract at 1,900. Later, the price falls to 1,800. You buy it back and your profit is the $100 difference. This is called shorting, and it's how you profit when the market is dropping. Let me give you a real life analogy, right? Let me think of one. Let's say your friend has a designer shoe and you're selling them now for $200, right? Then rebuying the same pairs of shoes later for $150 and giving the shoe back. You keep the $50 difference. That's shorting in action, right? Right? So why does it matters in future trading? So in the stock market, most people only think of buying low and hoping for the best, right? But in futures market, you can trade in any direction, which gives you way more opportunity. So here's why this is a big deal. Market don't always go up. They bounce, correct, or even crash. News, earning, global events can cause price swings, right? Future trading can capitalize on those swings, not just survive them. So whether the market is booming or in panic mode, you can be in a position to profit. You know, if you've done your analysis and manage your risk. So to recap, long versus short, in futures you can do both. That's what gives this market so much power and flexibility. It's one of the main reasons day traders, hedge fund, institution love future space, right? All right, now let's talk about something many traders overlook at first, right? Your trading style. But here's the truth. Future trading is not one size fits all. Everyone is wired differently, right? We all have different levels of patience, schedules, attention span, and risk tolerance. So the key to find a style of trading that fits you, not the other way around, is kind of like just to kind of give you a visual, right? So let me walk you through each one, right? And maybe by the end you'll have a sense of where you naturally fit. For me, personally, I guess I'm between a scalping trading and day trading, right? Swing trading, I thought about swing trading before position trading, but I said let me build up some more capital, then I'll go into swing trading, position trading, and I'll show you what each one means in just a bit. Scalp trader trade off of 1 minute to 5 minute chart, right? They're looking to grab tiny piece of price movement, just a few ticks at a time. They might place dozens of trade per day, trying to profit from short bursts of volatility. Okay, so the pros to this is that you get a lot of tons of trading opportunities, minimum exposure to overnight risk, and immediate feedback, right? The con is very high stress, right? And it requires lightning fast decision. So you have to be fast. You know, easy to burn out without strict discipline, and it's best for people who love speed, adrenaline, and thrive in fast-paced environment, right? It's not recommended for beginners, but amazing for those who master it, right? So day trading, this is the line. So day trading still moves quickly, but not as fast as scalpers, right? They typically trade on the 15 to 30 minute chart, right? They aim to enter and exit position within the same day. No holding overnight position, right? Day trading allows you to catch big intraday trends, avoid overnight news shock, and have clean slate each day, right? So the pros, let me show you the pros about a day trading. A solid opportunities for profit, active control over trades, and still avoid overnight risks. The con is require focus for several hours. Emotion management is critical and can be exhausting without proper planning, right? It's best for full-time traders, who those with flexible schedule and those who want to be active but not frantic, right? So swing trading, right? I have friends who are traders, but that's not my trading style right now. I can't, because I like to see profit quick. So now let's just kind of slow it down, right? Swing traders use 1 hour chart and 4 hour chart, right? And they hold trade for several days to a week. So here's what they analyze. They're analyzing trend, chart pattern, and key level of support and resistance. They don't need to monitor the chart 24/7, right? They can analyze in the evening and place a trade and let the market work while they go about their day, right? So the pro is lower stress than day trading, works with full-time job or school, fewer trade, more thoughtful analysis. So you can swing trade and still go and still have a full-time job and not having to look at the chart, because you're only coming back looking at the chart maybe after a day, or maybe you know yeah, after several days, So the con is that it requires patience and also trusting in your setups. Overnight and weekend risk is a factor, right? And it's best for people who like strategic, calm pace with time to think through trades. Now let's talk about position trading. This is a turtle. This is the slowest and the most relaxed style of trading. Position traders use daily, weekly charts and may hold trades for weeks and even months, like investing, but more active. They focus on economic fundamentals, macro trends, and broad technical signals. Now let's talk about the pros. Now, the pros is minimum screen time, ideal for people with limited availability, lower fees, and less mental fatigue. So the con is a very slow feedback, requires more capital for larger stops. And remember, I was talking about I would like to have larger capital to be able to swing trade and position trade. Emotionally harder to watch trade play out over weeks, because then sometimes you go into a trade and then let's say especially if you're position trading, you may have some pullbacks for weeks, and then it goes back up, so those can be emotionally hard too, just to watch your trade go down and then have to go up each time. It's best for long-term thinkers, professionals, or anyone who values simplicity and bigger picture moves, right? So which one you are, that's something that you would have to decide once you go into trading and see which one fits your style, right? So final tip, try them all in the demo account. You don't have to be committed right away. Test each style, and perhaps maybe the swing trading, position trading may take too long for you. But if you have enough capital, maybe that's something that you may want to experience with. So, check to see how does it feel. Does it match your lifestyle, or can you stick to the routine it requires? The most successful traders aren't the fastest or the flashiest, right? They're the one who found a rhythm that matches and who they are and built consistency over time. All right, now that we've explored the different trading style, now it's time to dig in something that applies to every style, no matter how fast or how slow you trade. How do traders actually decide when to enter and exit a trade? That brings us to one of the most popular and foundational methods in all trading, right? Price action. No matter what you go into, you have to understand price action. And then price action is what we explained before in the slide, is understanding some of the candlestick pattern and what the market is telling you, right? This is a strategy that's used by everyone from day traders to swing traders to institutional pros, because it's clean, powerful, and it's rooted in what really drives the market price itself. I use indicators a lot, and also sometimes you also use that in conjunction with price action, because price action does tell us a story, but then also use indicators to kind of help you confirm what you think price may be heading. So what exactly is price action? So price action is the art of reading the movement of price on a chart without relying on a bunch of indicators or automated tools. You're watching, this is what you're watching when you do price action, how price moves from one level to level, how it reacts to key areas, what kind of candlestick are forming, and whether buyers or sellers seem to be in control. It's basically like trading with a naked chart, right? No clutter, just raw price movement. And once you know what to look for, that simplicity becomes an advantage in helping you spot cleaner setups and clear decision points, right? So what price action traders look for? So let's break it down to 5 core elements of price action trading, right? So number one, the market direction. Recognize a trend is step one. It's like understanding which way the wind is blowing before you set sail, right? There are 3 types of market movement. There's uptrend, prices making higher highs and higher lows. Buyers are in control. Traders often to go long, right? On pullbacks, right? And that's what I did actually yesterday. I was trading off a pullback and I did very well. And so for example, think of a staircase going up, right? You want to buy when price steps back down briefly before climbing up. Okay, that's a pullback. So downtrend, price are making lower highs and lower lows. Sellers are in control. Traders traders look to go short on rallies, right? For example, a descending staircase. You sell when price takes a short step up before dropping back down again. All right, and you also have sideways range bound consolidation market, right? Price is moving in between 2 levels without breaking out. Neither buyers or sellers have good control. These zones often lead to big breakouts, right? So you never want to trade during consolidation when there's indecision. Price is not going either direction, but when it breaks out, that's when you want to go into the trade. So think of it like a coil spring, right? Building energy for a strong move up and move down. And one of the good indicators you can use for that is the Bollinger Band, right? So number 2, you have support and resistance, price memory. All right, these are price levels where the market has reacted before and is likely will again. And in my videos, I also talk about support and resistance. These are lines. Either you have the red line on top, right, which is resistance, and the green line on the bottom. And you'll see them on a lot of charts. And these are like, I call them like areas of significance, right? These are where price have reached before, price memory, and and also when it goes back to these levels, they also go back down. Like let's say if price is going up to a resistance level, right, because it has reached that level before, it will react to it, right, and come back down, just like support level is on the bottom, and it's usually green, right? It's like a floor where price tend to bounce back up because it reached that price before. It shows where buyers typically step in. So price often tests these zones multiple times. Traders use them for entries, exit, and stop placement. When price breaks through them, it can lead to strong momentum. Candlestick pattern, I've talked about it before. The market mood, market behavior. Now that you learned some common candlestick pattern, price action helps you use them in the right context. The trick isn't just spotting a hammer or doji. It's spotting it at the right place, like near support. Near support, potential bounce. At resistance, possible rejection, or during a trend continuation or reversal. For example, if you see a bullish hammer forming on a major support level, right, during a downtrend, that could be a signal that buyers are stepping in and a reversal is near. All right, so candlestick confirms what support and resistance already is hinting at. Breakouts. Breakouts are big moves waiting to happen. Breakout happens when price breaks above resistance or below support after consolidating. They often followed by high volume, strong momentum, big price move in a short time. Momentum. So momentum is the strength behind the moves. Lastly, price action traders pay attention to how prices move and not just where it's going. So ask yourself this question: is price surging or is it stalling? Are candles large or small? Is volume increasing or fading? Momentum tells you how committed the market is to its direction, and that can help you filter out weak setup. So the big takeaway is trade what you see, not what you think. Price action isn't about predicting the market, it's about reading what's happening right now and making a decision based on that. So you're not guessing, you're not reacting, you're just seeing how price behaves at key level and making high probability moves. Think of it like let's say learning it's like learning reading a body language in a conversation, right? So the market is constantly talking to you, and when you understand its signal, you stop chasing trades and start anticipating them, right? All right, now let's talk about trading indicators, tools that traders use to help them make smarter decision about whether to enter or exit trades. So indicators are like a dashboard of a car, right? They don't actually drive for you, but they give you important information about, speed, direction. So there are a dozen of indicators out there, some built for beginners, and we'll just focus on two main categories, right, that every trader should understand. So there's two types of indicators. There's lagging indicators, and also there's leading indicators. So I'll explain both what they are. So again, there's so many indicators out there that you can use as traders that that you use to confirm a trend, right? So lagging indicators, they confirm the trend. These indicators are called lagging because they use past price data to confirm what's already happening in the market. They don't try to predict the future. They help you. They help you because they spot trend, whether to stay in a trade longer or avoid getting shaken out by noise, right? So they're perfect for trend following. Who wants to confirm trend before making moves? Some lagging indicators are like the moving average, the EMA, the SMA. Moving average show the average price over a certain number of past candle, like the last 20 period, last 50, or last 200. When current price is above the moving average, it suggests an uptrend, and when it is below, it points to a downward trend, right? For example, if price is above the 50-day moving average and it keeps bouncing off of it, that's most likely a strong uptrend, right? So you might buy at pullbacks. There's two main types. There's a simple moving average, a smooth out price over time, and there's also the exponential moving average, which gives more weight to recent price moves, right? It's more responsive. Another lagging indicator is the MACD, and you'll hear MACD a lot. MACD just stands for moving average convergence divergence. This indicator uses two moving averages and also has a histogram. And again, I'm going to tell you to go back and research these indicators and understand how they work, because there's so much into these indicators, more than what I'm providing to you. So the histogram shows the trend, the strength, and potential momentum shifts. When the MACD line crosses above the signal line, that's a bullish signal, and when it crosses below, that's a bearish signal. So think of a MACD as a way to spot when momentum is building or slowing down inside of a trend. So now let's talk about, now that we've talked about lagging indicators, let's talk about leading indicators. So what are leading indicators? It gives you a heads up, right? Leading indicators try to predict what might happen next. They don't wait for confirmation. They show early signs of potential reversal, breakout, or momentum change. And these tools are best to identify overbought, oversold condition, or to spot turning points before they fully play out. So some of these leading indicators are like the RSI, the relative strength index, measures how strong or weak price action is. RSI is on a scale to 0 to 100. Reading above 70 means overbought, and reading below 30 is oversold. For example, if you see the RSI at 80 and price is near resistance, that's a potential selling signal. But the RSI alone doesn't mean that the market will reverse. It just suggests it might be stretched, right? So if the RSI is over 80, right? Over 80 means it's overbought. So at some point, prices you're gonna have the price is stretched, so it's going to come back down at some point. So sellers are ready to go ahead and sell off that 80 level. Another leading indicator is the stochastic oscillator, which I use in some of my strategy. It works like the RSI, but compares the closing price to recent price range, right? It's another way to spot momentum shift. Often gives earlier signal than the RSI, but also it does give you um, false alarms, right? So if the stochastic line crosses the bottom of the chart near support zone, that may be bullish. Reversal setup may be imminent. And also you have another leading indicator is the Bollinger Band. This tool wraps around price with three lines, right? The middle band, usually the moving average, and you have the upper and the lower band, which are based on volatility. When price touches the upper band, it may be overbought, and when it hits the lower band, it may be oversold. So if price is riding the upper band and the band are expanding, and that suggests a strong momentum, and if price is bouncing inside the narrowing band, a breakout may be coming, right? So the golden rule: use indicators for price action, not instead of it, right? So indicators are incredibly helpful, but they aren't like crystal balls, right? So they work best when combined with support and resistance, and candlestick pattern and trend analysis, right? Higher highs and higher lows. Example setup: prices at support level, right? And you have a bullish engulfing candle forming, and the RSI is below 30. That's a high probability of a buy setup using multiple tools together. So the recap, I would say just pick a few indicators and see what best works for you, right? And try to master them. Don't use too many indicators at once. You'll get confused and maybe paralyzed. Like my wife always say, analysis paralysis, something like that, right? Just pick two to match your style and get really good at interpreting them in real time, right? All right, so let's take a deep breath because this slide right here might just save your account one day. There's one topic every trader, no matter how skilled, must take seriously. It's this: risk management. And I specifically put this as the last slide so it can be the last thing you remember because it's so important. Here's the reality: even the most accurate strategy in the world can fall apart if you don't manage risk, right? Because in trading, it's not about being right all the time, it's about how well you survive being wrong. And then I remember one trader said it best and says, it's not how much profit you can make, it's how much you can keep, right? How much of the profit you can keep. So risk management is what separates amateurs from professional. It's how you stay in the game even after a losing streak, right? Because in trading, I've had four losing trade in a row. That's fine. That's just part of trading. You're gonna lose some, you're gonna win some. Just as long as you have more wins than losses, and that's what counts. It's what keeps your account growing steadily over time. So let's walk through three essential tools every future trader should master, whether you're scalping or swing trading, right? So you have number one, you have your stop loss, take profit orders. Number two, you have your trailing stops, and number three, you have your daily loss limit. And let me explain each one in detail. So stop loss and take profit orders. Plan your exit before you enter. So every time before you enter a trade, you have to have a stop loss. You must have a stop loss. Okay, so let's start with the basic. Every trade needs two exit points. Your stop loss. This is your safety net. This is the price where you say that if market hits this level, I'm out. Okay, it's it limits your loss and prevents one bad trade from spiraling into disaster, right? It's like wearing a seatbelt, right? You hope you don't need it, but you'll be glad it's there when things get rough, right? When you get in an accident, you have it and put it on, and because you had it on, it didn't get worse, right? So for example, you buy oil futures at $75 and you place a stop loss at $73. If price falls to $73, your broker closes the trade and you limit the damage, right? So it went down to $73, so you limit your trade. So what if you didn't have that stop loss of $73? Then let's say it went down to like 65, then you would have lost more. But if you didn't have that stop loss of 73, then you would have lost more money. Take profit, lock in your wins, okay? This is your cash out point where you secure profit before the market turns on you. It removes the temptation to get greedy or hold too long. The best traders don't hope for more, they execute with a plan, right? So my strategies have profit targets, right? Some profit targets, my strategy is like 100. I have one with the micro, it's $100 per day. 500, and I have another one that has $1,000 per day profit target. And some of my profit target, not just profit target, but also too, I have a limit on how many trades I can take per day, also too, in some of my strategy. Okay, so the magic is setting both a stop loss and a take profit. Is that it removes emotions, no panicking, no second guessing, just clean execution based on logic, right? Let's go to number 2, trailing stops. So what are trailing stops? Trailing stops lets your winners run without giving it all back, right? A trailing stop is like a dynamic stop loss that moves with the market in your favor. So let's say you're long on the NASDAQ, right? You're going long at $14,000, right? 14,000, and you set a trailing stop at 20 points. So if price rises to 14,100, your stops moves up to 4,080. If price keep rising, your stops keep climbing up, right? So if price drops to 20 points from the high, then you're out, but you've already locked in the profit. Again, there's video that explains this, so you can go YouTube and search what are trailing stops, and you'll have a visual of what trailing stop is. And it's great because I have 2 contracts. One contract I have a set profit target, and the second contract is a trailing stop. So as price moves in my favor, I just manually move my stop loss. My stop loss can be 10 tick or 20 tick behind the current price. So I'm constantly moving. And once it drops and I get stopped out, I've already made my profit already, now that it went back down. So this is a powerful tool when you want to ride a trend and still protect your profit, and you ensure exactly where the trend might end, and you want to set it and forget it with confidence, right? Just make sure the trailing stop distance is wide enough to allow for normal fluctuation, because price moves up and down. Because if price goes up, sometimes it'll pull back, so you want that little bit of wiggle room, so you don't get stopped out too early, right? So thirdly is the daily loss limit, right? Know when to walk away. This is one of the most overlooked but most important discipline tool in trading, right? So daily loss limit is a rule you set for yourself, right? If I lose so much money in one day, I'm done. I step away. No revenge trade, no exception, right? Why does this matter? Because losses just hurt your account. Losses don't just hurt your account. They mess with your mindset, right? So after a big loss, emotions take over. You start forcing trade. You abandon your plan and you try to win it all back, right? Once you get a couple of trades against you, right? So for example, if you set your max loss at 200, right, per day, right? If I lose $200 for the day, I'm done for today, right? And you hit it by noon, that's your signal to shut it down for the day, reset, regroup, and come back the next day, right? This rule protects you from emotional spiral, right? It forces you to respect the market and not fight it, and it builds long-term consistency, right? So bottom line, risk management is your superpower. Let's be real. You'll have losing trade. Everyone does. What matters is how You respond when it happens. Risk management isn't about being afraid to lose, it's about having a plan for when you do. Think of it like this: strategy makes you profitable, risk management keeps you alive long enough to profit. So, the recap, right? You must have a stop loss, take profit, a trailing stop, so you can ride the trend, and a daily loss limit, okay? So you can limit your worst trading days, right? So, all right, we've officially reached the end of this beginner-friendly journey into the world of future trading. Whether this was your very first introduction or a refresher, I hope you're walking away with more clarity, more confidence, more curiosity. Let's just quickly recap the key takeaways and what they mean for you going forward. Okay, like I said again, this is just an overview. There's a whole lot of information that you need to read on and understand about future trading, but this is just kind of like an overview. So just to recap why future trading stands out, right? We started by exploring the unique advantage of future trading: leverage, control large position with less capital, increasing both opportunity and responsibility. It's 24-hour access. You can trade around the clock, even when other markets are closed, right? You profit in both directions. You're not stuck waiting for prices to rise. In futures, you can go long or short and profit either way. This flexibility is why future attracts traders from all walks of life, from hedge funds to home and office, right? Number two, choose the right setup for you. We talked about how broker, platform, and trading style needs to fit you, not the other way around, right? Some people thrive in fast-paced environment like scalping, day trading. Others prefer a more relaxed approach like swing or position trading, right? There's no one right way. It's about knowing your own personality, schedule, risk tolerance, and aligning your tools and routine accordingly, right? Number three, learn to read the market language. We dove into the core skills that help traders make more smart decisions. Candlesticks charts, so you can see who's in control, buyers or sellers. We talked about price action, so you can react to real-time market behavior. And also we talked about indicators, both lagging and leading indicators that add structure and confidence to your trade. So these tools are just how you listen to the market and when to use them together. They help you spot high probability setup with clarity and purpose, right? Number four is risk management. This is your lifeline. Finally, we emphasize on this: the one thing that makes or breaks every trader: risk management. Stop loss, protect your downside, take profits, secure your wins. Trailing stop lets you ride the trend while staying safe. Daily loss limit, keep your emotion in check. This is the difference between gambling and trading with discipline. Your capital is your fuel. Protect it, and it will take you far. So what's next? So if you're just starting out here, this is your game plan. So number one, keep learning. All right. Watch videos, read books, study charts. Practice. Use demo accounts, right? Demo accounts, I use a lot of demo accounts. I practice a lot with market replay and back testing. You're kind of like practicing as if you're practicing real. So once you get consistent, me, I wait till I get consistent for about a month, and then I start doing my strategy in real time. Number three, build a routine. Set aside focus time to study, plan, and review, right? Number four, develop a discipline, right? Focus on good habit, not just on fast profit. Like I said again, it's not about the profit you make, is how much you can keep. Okay, you have to be consistent. All right, treat it like a business with goal, with structure, and accountability. All right, and so lastly, my final thought, right? Future trading is powerful, it's fast, it's flexible, and yes, it can be profitable. But success doesn't come from chasing every trade or relying on luck. It comes from consistent effort. Your emotions got to be in control, and you have to have a commitment to learning. This didn't take me 6 months to learn. I've been at this for learning, just understanding futures market for 2 years now. 2 years. It's just taking me 2 years to really get a grasp on it. So this won't take you a week or just watching this video and then you have control or understanding of the futures market. So it does take time. So take your time, respect the market, and most importantly, stay curious, stay humble, and keep improving one trade at a time. So again, I want to thank you so much for watching my video, and I hope this kind of gives you a solid foundation to start building on. Also, please remember to like, subscribe, and I hope to see you on my next video. So good luck out there and trade smart. Bye.